Good morning. Thank you for joining this morning's webinar. Today, we're going to go over the Mega Backdoor Roth Solo 401k, specifically what income sources can I use to make contributions. I'm going to go ahead and share my screen here. As always, today's presentation is for informational purposes. We're not providing tax advice or financial advice on today's webinar. Before we start talking about the Mega Backdoor Roth Solo 401k, specifically what income sources you can use to make contributions, you first need to understand the eligibility requirements to open a solo 401k plan. Qualifying for a solo 401k is pretty easy. You need to be providing self-employment income. Excuse me, you need to be providing self-employment activity with the intent to make earned income from self-employment activity. So in short, a solo 401k plan is for owner-only businesses, aka the self-employed. Second, you cannot employ any non-owner W-2 employees in your business that work full-time. Full-time is defined as a W-2 individual that's not an owner of the business, hence why the terminology common law employee, who works 1,000 hours or more. As long as you don't employ a W-2 non-owner employee that does not work 1,000 hours or more, then you would qualify for a solo 401k plan. That hour test needs to also be applied at all of your businesses level. For example, if you own multiple self-employed businesses where it's just you or you and your spouse, and any of those businesses employ a full-time non-owner W-2 employee who works 1,000 hours or more, that would preclude you from being able to open a solo 401k plan. Now, the owner's spouse may also participate in the plan. For example, you might be self-employed in an LLC that's taxed as an S corporation or taxed as a sole proprietorship, and you are the owner of the business, but your spouse is not an owner, but he or she does work in the business. That means that both of you would qualify for the plan. The solo 401k plan would be sponsored by the LLC, which is the self-employed business. Both of you work for the business. Therefore, each of you would be participants in the plan, and you would have separate holding accounts under the plan to hold your respective funds. So those are the eligibility requirements from a solo 401k perspective. Now, continuing with the example of a plan where you have two participants in the plan, here's a good slide that goes over the need for separate holding accounts under the plan. So again, this is an example of a two-participant plan. Let's say both spouses are working in the same business. The business sponsors the plan. As you can see here, each spouse is going to have three separate holding accounts under the plan to hold their respective funds under the plan. So the first bucket, aka a bank or brokerage account, is used to hold the pre-tax solo 401k funds. The second bucket is used to hold the Roth solo 401k funds. And the third bucket is used to hold the voluntary after-tax solo 401k funds. Hence, a total of 6 holding accounts, 3 of each source type for each participant. Up above, this other slide here, this is an example of a one participant plan where there's just one participant in the plan. Let's say that you're now married or your spouse is not working for your business. Therefore, it's just one plan, just like it's only one plan when it's two participants. But here, Instead of having 6 holding accounts, now it would be 3 holding accounts because it's only one participant in the plan. So 1 pre-tax, 1 Roth, and 1 voluntary after-tax. Okay, let's talk about the income that's used for making voluntary after-tax solo 401k contributions as part of the Mega Backdoor Roth solo 401k, aka Mega Backdoor Roth. We'll look at it at each entity type. Before we continue, let's take a look at one of the questions here on the live stream. If I open a plan now, and I did not make any contributions as an employee last year, and W-2 is already issued, can I still make a contribution as the employer plus profit sharing for 2024? When making contribution, where does the contribution come from? The business account or the business owner's personal account? My business is a solo owner S Corp. Thank you. So the business in this case is S Corporation. So the S Corporation sponsors the solo 401k plan. Therefore, all contribution types, whether employee or employer profit sharing, are going to be based on your gross 1 W-2 wages. So box 1 is titled gross wages of your W-2. Those gross wages of that W-2, it's what is the income used to calculate the contribution amount. If we're talking about tax year 2024, if you are opening a solo 401k plan for the first time here in 2025, you still have time to open the plan here in 2025, which will need to be done by March 15, so that you can make employer contributions for tax year 2024. You will also be able to make voluntary after-tax solo 401k contributions for tax year 2024, as long as you go ahead and open that solo 401k plan here in 2025. So that being said, since your question is pertaining to employer contributions, as long as you open that solo 401k plan here by March 15, or if you file for a timely extension, you can even wait till September 15 to open the solo 401k plan here in 2025, and you'll be able to make contributions, both voluntary after tax and employer contributions for tax year 2024. As an example, if your W-2 wages box 1 is $100,000 for 2024, so if you received a W-2 that shows $100,000 of W-2 wages, you're going to be able to do a profit sharing contribution, and also known as an employer contribution of $25,000. We get to that $25,000 figure because it's a percentage when you calculate employer profit sharing contributions. Therefore, it's a 25%. So 25% of 100,000 is $25,000. That contribution can flow from your business bank account or your personal bank account. What matters is 2 items. Number 1, that you had the W-2 wages to support that contribution, so 100,000, so that you can contribute that $25,000 in my example there. And then number 2, that you report that contribution, that employer contribution on your corporation tax return. So if it's an S corporation, that employer profit sharing contribution is going to be reported on the Form 1120S. Let me pull up my cheat sheet that will show the exact line number of that 1120S for reporting contributions, employer contributions. So here's a great resource from our website. Let me send this link over regarding where contributions are reported. Scroll down to the S corporation. Here we are. So both for an S corporation and a C corporation, actually, excuse me, for an S corporation, the employer contribution is going to be reported on 1120S, line 33, excuse me, line 17. So form 1120S, line 17 of that 1120S is where the employer profit sharing contribution is reported. So the link I sent over has a cheat sheet that I'm looking at here. Okay, let's get back here to the presentation. And share my screen here. So again, today we're talking about the Mega Backdoor Roth self-directed 401k. Specifically, what income sources can I use to make contributions? So in order to contribute to a solo 401k plan, whether you're making contributions such as voluntary after tax as part of the Mega Backdoor, or if you're making pre-tax employee or employee Roth or pre-tax employer or employer Roth, you're going to have earned income from your self-employed business in order to contribute. Now, a quick way to identify earned income is to understand that it's material services. So you have to do the work and then get compensated for doing that work. So if you don't pay yourself, you're not going to be able to contribute. So you need to pay yourself from the self-employed business in order to contribute. And earned income from self-employment activity is it's subject to Social Security taxes. So that's another way of distinguishing earned income, which is required for making solo 401k contributions versus investment income or passive income or interest income, which is not considered earned income, and therefore it's not considered self-employment income, and as such, you cannot contribute to the plan if you don't have any earned income. So let's say you're a sole proprietorship and you receive Schedule E income. Well, that's investment income. That's not considered earned income. Using the sole proprietorship example, you would need to have Schedule C earned income to qualify for a solo 401k and to be able to make contributions to the solo 401k. On that front, let's look at the sole proprietorship to determine what income source you can use for making Mega Backdoor Roth solo 401k contributions. So specifically, if you're a sole proprietorship or if your business is taxed as a sole proprietorship, you might have an LLC that's taxed as a sole proprietorship, and therefore your sole proprietorship gets a Schedule C. You're going to need to have line 31 of your Schedule C. That's the net profit or net loss figure from self-employment activity if your business is taxed as a sole proprietorship. So that's going to be the starting figures, line 31. And then you have to subtract 1/2 of self-employment income from that line 31 for making those contributions. So for a sole proprietorship, it's going to be line 31 of your Schedule C. That's the starting figure. You plug that figure onto our calculator, and the calculator will subtract 1/2 of self-employment income tax, and then you'll be able to make a contribution. Now let's take a look at the necessary earned income if the self-employed business is taxed as a partnership. So if your business is taxed as a partnership, let's say you have an LLC taxed as a partnership, you're going to have earned income reported on that Schedule K1. So you're going to need line 14 with the code A of that Schedule K1. That's the income that's going to be needed to calculate your voluntary after-tax solo 401k contribution so that you can do the Mega Backdoor. So again, Going to be line 14 with the code A of your schedule K1. You plug that figure onto our calculator, and then our calculator will subtract 1/2 of self-employment income tax, and then you'll know how much you can contribute to the voluntary after-tax solo 401k. So again, line 14 of that schedule K1, aka Form 1065. Now, if the business is an S corporation or a corporation, the income source that you're going to need to do voluntary after-tax solo 401k contributions, or I should say make voluntary after-tax solo 401k contributions and then convert it over to the Roth solo 401k or the Roth IRA as part of the mega backdoor self-directed strategy, is you're going to need W-2 wages. So you're going to need to look at W-2 box 1. So box 1 of your W-2 is going to be the starting wages for the calculation. Now, if you also have a figure listed in 12A of the W-2, you may need to add that figure to that box 1 so that you have the gross wages to maximize the contribution calculation. For example, if you have box 1 W-2 wages of $100,000, and we're talking about 2024 solo 401k contributions, moreover, voluntary after-tax solo 401k contributions, you're going to be able to contribute $69,000 as a voluntary after-tax solo 401k contribution, and then convert that over to the Roth solo 401k or the Roth IRA. Actually, you only need $69,000 of W-2 wages, box 1, because the voluntary after-tax contribution is a dollar for dollar calculation, not a percentage when we're talking about an S corporation or a C corporation. So both for an S corporation and a C corporation self-employed business, you're going to look at box 1 of your W-2 wages to determine the contribution amount you can make for the voluntary after-tax solo 401k as part of that mega backdoor self-directed 401k. Okay, so let's see if we have any other questions here, and then we'll talk about the mega backdoor steps here. Looks like we got a question here. I have a solo owner S Corp, and I only set up my solo 401k this year. Am I understanding correctly that voluntary after tax year for tax year 2024 will not be taxable until 2025 tax return, which is when it's distributed to the Roth account? So number one, voluntary after tax solo 401k contributions go into the solo 401k plan on an after tax basis, which means you don't get a tax deduction for that contribution, but in return, it goes in as an after tax, and then you immediately convert that over to the Roth solo 401k or the Roth IRA. That's effectively what the mega backdoor self-directed strategy is. The mega backdoor Roth self-directed strategy is. It's where you make a voluntary after-tax contribution. In your case, since your business is taxed as an S corp, it's going to be based on your W-2 wages. So again, if you had W-2 wages for tax year 2024 of at least $69,000, so if you report at least $69,000 of W-2 wages of box 1 for 2024, you can contribute that entire $69,000 as a voluntary after-tax solo 401k contribution for tax year 2024 here in 2025, and then you can convert it to the Roth solo 401k or the Roth IRA. Okay, let's look at the steps for the mega backdoor Roth strategy, as we're on that topic. So here's a great slide from our website that we're going to go over here, and I'm going to share that link. that talks about the steps required for the mega backdoor Roth strategy. There's that link in case you want to take a look at it. So obviously you need to, if you don't have a solo 401k already, you need to open one with a self-directed solo 401k provider whose plan documents allow for the mega backdoor Roth strategy, as not all 401k plans allow for the mega backdoor Roth strategy. A plan from my solo 401k financial is such a plan that does allow for the mega backdoor strategy, the mega backdoor Roth strategy. Once you identify the self-directed 401k provider that you want to use for your self-directed solo 401k plan, then you would open that solo 401k plan with that specific provider. Once that plan has been opened with the self-directed 401k provider, you're going to have separate holding accounts under the plan. One of those is going to be designated as the voluntary after-tax bucket. Again, back to the prior slides I shared earlier, where you are required to have separate holding accounts for each source of funds, that is pre-tax, Roth, and voluntary after-tax funds. One of those is going to be the voluntary after-tax fund bucket. So for instance, if you open a solo 401k with my solo 401k financial, our clients can use Fidelity Investments or even Schwab to hold the solo 401k funds, and they'll provide a voluntary after-tax bucket for that self-directed 401k. It'll be designated as the voluntary after-tax bucket. So you would make the contribution. Let's say that's $69,000 for 2024 if you're an S corp. The overall limit for 2024 is $69,000. And again, the voluntary after-tax solo 401k contribution is a dollar for dollar calculation. So all you need is 69,000 of W-2 wages to maximize that voluntary after-tax contribution. So step one is you make that contribution into the voluntary after-tax holding account, or excuse me, first you open that designated account, titled voluntary after-tax. Step two is you make the contribution into that voluntary after-tax brokerage account, bank account labeled voluntary after-tax. Once those funds are in that voluntary after-tax bucket, then you need to move those funds from the voluntary after-tax bucket to the Roth solo 401k, which is another bucket within the plan, or you can move them to a Roth IRA. So that's step three. Once you've converted those funds from the voluntary after-tax to the applicable Roth, that will result in the mega backdoor Roth strategy. Then under step four is it needs to be reported. That conversion, that mega backdoor Roth conversion is not taxable per se, but it is reportable to the IRS. That's going to be reported on a Form 1099-R. So you need to complete our online conversion form on a timely basis so that we collect that necessary information to then complete the final step of the mega backdoor Roth, which is issuing the Form 1099-R, which gets issued to the IRS and a copy to you as the participant for reporting it on your taxes. So those are the steps in the mega backdoor Roth, a total of 5 steps. This slide here breaks down each step in more details. So take a look at that. I share that link. We often get the question of, should I convert my voluntary after-tax self-directed 401k contributions to the Roth 401k or to a Roth IRA? Well, generally, most clients will convert it to the Roth solo 401k. Reason being is they want to consolidate their retirement accounts under one plan. So that's one reason. The second reason is that you can take a loan known as a 401k participant loan from your self-directed Roth 401k, which is not allowed under a Roth IRA. When you borrow from a self-directed 401k, you can borrow 50% of the total balance not to exceed $50,000. So for example, if the value of your 401k is 60,000, the maximum you can borrow would be 50% of 60,000, which is $30,000. Another example, if the value of your self-directed solo 401k is $100,000 or more, the maximum you can borrow is $50,000. And then you would pay back the 401k. So if you borrow those funds from the self-directed 401k bucket, you pay back, and those funds go to the self-directed 401k bucket. Another reason why clients like to convert to the self-directed Roth Solo 401k once they make that voluntary after-tax contribution is that they like to invest in alternative investments like real estate. Yes, a self-directed 401k is allowed to invest in alternative investments like real estate, whether it's family homes or commercial real estate. When a self-directed 401k invests in real estate, and it can obtain additional financing through what's called a non-recourse loan. So the loan is to the self-directed 401k. That loan is provided generally by a hard money lender or a bank. To the 401k, it's got to be non-recourse. And the payments on that loan are paid by the 401k, but now the 401k will have more funds to invest in real estate. So that's a common method that our clients use, is they'll invest in alternative investments like real estate, and will utilize debt financing to invest in real estate if their 401k doesn't have enough funds to make that real estate investment, or if they don't want to tie up all their self-directed 401k funds in just that particular real estate investment. Okay, let's see here if we have any other questions for now. Here's a question here. I am ready to make after-tax contributions for tax year 2024. Then I want to move it to the Roth 401k. Do I just call Fidelity and have them do it all in one call? Great question. If you have a self-directed 401k with my solo 401k financial, and you used Fidelity Investments to open up what they refer to as non-prototype investment-only brokerage accounts, which are the type of holding accounts that Fidelity provides for a self-directed 401k offered by a company such as my solo 401k financial, then the next step is to make that voluntary after-tax contribution, which you'll do electronically. You can do it by linking your business or personal bank account to that voluntary after-tax brokerage account. Let me send that link over. So that's step one, is you need to make that voluntary after-tax contribution first. Give me a moment here and I'll get that link. And then we'll go over the rest of the steps here. I'm going to search our search box on our website on the top corner there, top right corner. So here's what making the solo 401k voluntary after-tax contribution to the Fidelity Investment non-prototype investment-only brokerage account. So this is a good resource here. It'll show you how to link your bank account to that Fidelity brokerage account to make that contribution electronically. It's set up on your bank side. Here, I just shared that link with you. You can also, let me show you, let me send another link over that talks about the various methods of making contributions. So again, the first step is to make that voluntary after-tax contribution to that voluntary after-tax solo 401k bucket. Once that's done, then you need to convert it over to the Roth Solo 401k, so the Roth Solo 401k bucket, and you can call Fidelity Investments, and they can move those funds over the phone for you from that bucket, the voluntary after-tax bucket, to the Roth Solo 401k bucket. Alternatively, you can also submit a form to Fidelity to instruct them to move it over. Let me share that link with you. So the answer to your question is first you make the voluntary after-tax contribution, then you can convert it to the Roth Solo 401k by calling Fidelity. They'll do it over the phone, or you can submit a form directive. And let me share the link to that form directive. Give me a moment here. Okay, here's the page here. That's the page, but let me share the link with you. And we have step-by-step instructions here on how to fill out that form directive to instruct Fidelity to move the funds from the voluntary after-tax solo 401k bucket to the Roth solo 401k bucket. But once you have those funds converted to the Roth solo 401k bucket, you then need to go to our website and complete our online conversion form so that we collect the necessary information to issue that Form 1099-R. Here's the link to that form. Well, there's the link to that form on our website that you would need to fill out so that we collect the necessary information to issue that Form 1099-R. Now, keep in mind that the 1099-R will not be issued till next year if you are processing the conversion here in 2025. Why? Because conversions are reported in the year that the funds are actually converted. So don't confuse the voluntary after-tax solo 401k contribution rules with the conversion rules. Those are two separate rules. Voluntary after-tax solo 401k contributions can be made by your business tax return due date plus timely filed extension. So if you're making a contribution, a voluntary after-tax solo 401k contribution in 2025 for 2024, you can do that here in 2025 by your business tax return due date plus timely filed extension. However, the conversion is not happening until this year. So if you convert those funds from the voluntary after-tax solo 401k to the Roth solo 401k or the Roth IRA, that's going to trigger a Form 1099-R for tax year 2025, which will be issued by January, February of 2026. Either way, it's going to be non-taxable because conversions, when they're made up of voluntary after-tax funds, are not taxable. Just the small earnings will be taxable, but not the actual basis. So whether that conversion is done in 2024 or 2025, it's still going to be non-taxable regardless, unless there's a little bit of earnings, which was earnings will be taxable. Okay, so hopefully that takes care of that question there. If as far as any other, I don't see any other questions here in the live chat. We really appreciate you joining. Again, we'll be back at 1 p.m. Pacific time. We're on every day, a couple times a day. Once at 10 a.m. Pacific time and a second time at 1 p.m. Pacific time. Today we went over the Mega Backdoor Roth self-directed 401k strategy, specifically what income sources can I use to make contributions. Again, please subscribe to our YouTube channel, like it for more videos like this. And until later today, have a good morning.